Welcome to where everything marketplaces meet the investors event, which is going to be a live discussion with investors that are joining us as guests today. So on that note, I'm really excited to welcome our guest, Neel Murthy from Pioneer Fund, Andrew Blachman from Marketplace Capital, so of course my awesome partner, and Matt Brown from Headline. As a quick note for everyone on the event format, this is going to be a moderated conversation with our guest, and we'll have a roundtable discussion on a few topics, and then we'll of course be wrapping it up with the group Q&A at the end. We'll try to start the group Q&A at around the 30 to 35 minute mark. We'll be using the Google Doc. And so, of course, that had the questions that were added in advance. So if you did add a question that was highlighted, you can use the Zoom raise hand functionality once we get to the group Q&A. So that way I can call on you and you can come on to ask it directly. I did once again want to mention to please keep the questions brief. It should only take about 15 to 20 seconds or so to ask it at most. And we have a larger group today, so this will help us get through as many questions as we can. So with that out of the way, I'm really excited to kick off the conversation here today. I want to start by saying huge thanks, to our guests for joining us. And we're going to start with a few brief introductions. So we'll start with you, Neel. Can you give us a brief, introduction and then overview of Pioneer Fund?
Happy to, Mike. Welcome everybody. Neil here. I was a computer science background and engineer by trade. I joined Y Combinator in 2013, which was my first real foray into entrepreneurship, and kind of haven't looked back since then. And then in 2017, a group of us alumni started a fund called Pioneer Fund, focused on investing in YC companies. It's now grown to a community of about 490 YC alumni that have invested in the fund. So we think of it as a bit of a powerhouse of entrepreneurs and investors. And that's been going well. We've started now also investing a little bit outside of YC into folks that we think are a little bit ahead of YC, could apply. One example of Ajit, who's in the chat right now, I think, was at Cactus, formerly Craved. We had been talking to them before they got into YC. We do interview prep. We do all of that as well. So if you're applying to YC, a good way to do to get help there is to talk to Pioneer Fund. We have, like I mentioned, 490 alumni, and I'll end there.
Awesome. That's a great background and quick overview, so appreciate it. And then we'll call on you, Andrew. I'll also have to mention that you're my awesome partner for Marketplace Capital. So when you mention it's we, but maybe if you can start with a brief intro.
Sure. I'm Andrew. I, with Mike, run Marketplace Capital, and we are an early stage fund focused entirely on marketplaces, as you can probably imagine. We invest at pre-seed and seed stages. We say we'll do Series A's as well, but we haven't yet done a Series A. So we really focus on the pre-seed and seed stages, and we invest relatively small checks between $100,000 and $250,000 alongside other institutional needs. And so the thesis behind the fund is really simple and probably one that a lot of you share, which is that marketplaces, when they work, they create the greatest outcomes in venture investing. But that also the observation is that marketplaces are really hard to build. And so Mike and I believe that if you can combine a fund with a community, you can spot breakout marketplaces early, and then you can also support the marketplaces that you invest in. I primarily have been a marketplace operator myself, so I've been in your shoes. I have been involved with a few different companies. Most notably, I ran a company called Get Me In, which is a ticketing marketplace in the UK and Europe. We were very much like StubHub, but in Europe. And we grew that company and then sold it to Ticketmaster well, I won't say when, it was a while ago now, and then ended up running Ticketmaster's international resale marketplace and just kind of fell in love with marketplaces and network effects and the dynamics associated with those businesses. And so I've been involved with marketplaces ever since. Um, so excited about this fund and happy to talk to folks today.
Awesome. Appreciate it. And Matt, you want to come on, give us a brief intro and overview of Headline?
Yeah, exactly. Well, thanks everyone for being here. My quick background, got into venture pretty early in my career, started a student fund while in college, then worked for a fund in New York called Stripes. So we did Grubhub and Seamless in the early days, Udemy, GoFundMe, a number of internet marketplaces in the mid to 2010s. Then actually got the entrepreneurial bug and jumped over to the operating side for a marketplace business called WAG, Uber for dog walking. Ended up raising around 400 million in funding and stayed there through the Series D. It got SPACed a couple of years ago and is now a public company. Then went to a fund called the Churning Group, which is very sort of content, community, consumer oriented, and we did a number of vertical marketplaces there. So a company called Collectors, which is sports cards, memorabilia, coins, the whole collector economy. We did a Hodinky for watches, the Pros Closet, for biking, Zola, wedding marketplace. So a bunch of different vertical marketplaces there, and learned a ton. And then came over to Headline a few years ago to help lead the consumer internet and marketplace team. We have a deep marketplace history. We back things like The Real Real, Farfetch, GoPuff, and others. And then we recently did a Series A in a company called Palm Street, alongside Marketplace Capital. And it's a marketplace for live streaming plants, reptiles, crafts, sort of a lot of the Etsy categories is going quite well. We focus on seed plus Series A and Series B. So typically need to see, typically like 5 million plus in GMV. We could get into some of the dynamics of the Series A market a bit later. But really, we're starting to see some signs of product market fit, which we could dive into later.
That's going to be helpful for us. So appreciate the quick backgrounds and overviews. I'm sure lots of founders here today to learn more about the current state of fundraising at the earlier stages. So I thought it'd be good to spend some time in that. So Neil, could you maybe start off with sharing a little bit more about what you're seeing as far as the some of the observations on the current state of fundraising at the earlier stages? So I would say like initial kind of angel to pre-seed stages.
Yeah, I think right now is the best time if you're trying to raise angel and pre-seed. There's so much capital in the market. There's a lot of people that are active as angels. There's a lot of folks that are trying to move earlier stage. The reason for that is I think there's a lot of belief that folks may not need to raise as much later stage capital, which I'm sure we'll get into in the sort of rise of AI. And so I think, there if you're looking for folks, like you can find them. Now, the matching process is obviously still as hard as ever. I am obviously biased. I think for a lot of early stage founders, accelerators are really helpful, especially if you're looking for like creating a fundraising moment. And I'm happy to talk about the sort of accelerator model. I'm obviously biased to Y Combinator, but there's actually so many entering the space that you can chat with. Actually, you know what? Let me take a few seconds there. Outside of YC, I think, one that's been kind of growing a lot and has kind of entered, if you're especially in LA, Speedrun. I've heard really good things about them. HF0. There's like all of these sort of opportunities for founders, especially I think with a good founder market fit thesis. So even pre-idea, just entrepreneurs that are trying to build something and have a really good connection to the space they're building in. There's quite a few folks taking that bet. And accelerators, I think, are a good way to get angels interested, as well as creating that sort of that FOMO opportunity with the demo day. So for folks that maybe are finding a little bit difficulty in straight raising from angels and cold outbounding and that sort of outreach process, that would be my number one piece of advice. And I'm happy to chat with folks about like which accelerator is right for you. Again, I always go apply to YC. There's a lot of opportunity there, but that's not the right fit for everyone. And I know it is expensive. So there are other opportunities there. But in general, I would just end with, there's quite a few folks moving early and early stage. The multi-stage funds are entering as well. So quite a few opportunities. And I think now is the time to start a company. Now is the time to start a marketplace company, which for many reasons, but one of which is the funding opportunity. The other of which is just the building opportunity, I think is huge to build a marketplace.
Got a lot of head nods at that one. So cool. So kind of moving on to I would say like the pre-seed and seed stage. We'll let you come on, Andrew. Could you maybe I guess like first off kind of share a little bit more about what those rounds typically kind of look like, and then what the fundraising environment is like at those stages.
Yeah, I would echo a lot of what Neil said. I think just about the dynamics right now. And obviously we're biased as well. We feel that early stage investing is where you want to be right now. Um, the companies, I would just say, like very anecdotally, the companies that we're looking at, compared to like when I was building, or even like compared to 5 years ago, are so much further along, even at the pre-seed and seed stages, because you can get there with less capital. That's one of the reasons, and because um, there's more and more people building in the space. So, I mean, we look at it. I guess one way to think about it is like a supply and demand. Like we're market, the early stage marketplace is the same thing as like marketplaces you guys are building. There's a supply of companies that are out there raising money, and then there's the demand. Um, and I feel like both are really, really strong right now at the early stages because again, more people are going into the startup journey. I talked to a lot of I talked to a lot of like early founders, and I just feel like there's so much uncertainty in every other career path right now, and startups have always been uncertain, but now everything else is just as uncertain. So might as well take a bet on yourself and build a startup. And so we're seeing more and more people go that route. And then on the investing side, um, there is a lot of capital, as you mentioned. There's also a lot of uncertainty about the venture model in general, and so there's lots of questions about raising big funds. Does it make sense, or small funds? But if you're raising at the pre-seed and seed stages, there's plenty of capital. I think there will be for quite some time. Just to give you a color of what we do, we don't lead deals. We only invest alongside an institutional lead. So I don't know if this advice is applicable for everyone, but those are kind of the typical deals that we look at. And I do agree with Neel that these accelerators are great for a lot of startups and a lot of founding teams. They're not as great for investors looking at investing in companies because they drive valuations up, or at least a lot of them drive valuations up, and sometimes it's not in everyone's best interest. But I think um, they really help companies, especially if you haven't done it before, if you're a first-time founder, and kind of put structure around it. And I absolutely agree with like the momentum around like a funding event is really important. We can talk about some of those like very practical tips later. But it's very helpful to have a forcing function when you're going out to raise money. And we're also in a position where because we write relatively small checks and we collaborate with other investors, we can hopefully give advice and steer people in the right direction when it comes to fundraising.
I just wanted to add one thing to Andrew. The win-win scenario is we as an investor invest in a company, help them through the accelerator, help them build that momentum. We as the investor get the markup. The company gets someone on their back end to like help them navigate an accelerator community, which is not easy. It's not straightforward to run a demo day process. So I think
Yeah,
that's when like the stars align and everyone wins in this process. So yeah, I'll just add that last point.
totally. No, and again, I was just being a little facetious. Like it's amazing. Like, actually, I would say the quality of the companies that you see coming out of accelerators, or at least their ability to pitch effectively, is really dramatically um, different than the average startup that you come across. So I highly recommend people look down that path, especially coming from a founder perspective.
Awesome. And maybe for both of you here, we'll start with you, kind of Andrew, on it. But you mentioned valuations, right? And also too, like related to that, has come up a few times recently in the community, which is founders asking, like, what are the typical kind of benchmarks that are needed to raise like pre-seed right now? Going down the venture route, and then learning a little bit more about what the deal sizes are, kind of valuations, et cetera.
This is always a moving target. People always ask for, what's the number? And the truth is there isn't really a number. It's more um, what's the phrase? It's not like a dot, it's a line. So it's like not just showing like where you are today, but how it's moving. So we've invested at pre-seed and stages, pre-seed in companies that are pre-revenue. But most of the time that's not the case anymore, even at pre-seed, which is a very strange thing to say. Pre-seed is not your first money. The angel round would be your first money, but the pre-seed check, we've very rarely have invested in something even at that stage that has no revenue. And the benchmark used to be, you want to get to $1 million run rate of net revenue, not of GMV, but of net revenue before you can do like a Series A. But I would say now that number I think is much higher than that based on what we've seen. And not that it's like, well, investors have higher standards now, it's because companies are able to achieve more very quickly. And so I would say like that's the kind of the range of the seed round is like anywhere from like 0 to $1 million $1 million of net revenue. But more importantly, the trajectory of that and whether it's growing is really, really key.
It's very nuanced as well. So, do you want to add anything to that, Neil, or we'll move
Yeah,
on?
just quick ads. Agree with a lot of what Andrew said. I would say like at early stages, valuations to me are kind of made up to some extent. You raise at the number that you can raise at, and I would also advise folks to take capital when it's there. So, especially with safe constructions and things like that, you can always raise the cap as more money comes out there, and there's really no rules to the game to take the money that's out there because you never know when you're going to need it. And it's also good to not have to raise again. Like that's the goal for everyone, right? To get to raise a small amount of capital and then not have to raise again.
Awesome. Then, kind of moving on to you, Matt. I thought it'd be helpful. Could you maybe kind of share a little bit more about what you're seeing? I'd say like at the seed and seed plus kind of Series A stages as far as the current fundraising environment.
Yeah, so we focus at Headline on like $5 to $15 million Series A investments, and then we'll do Series B as well, call it like $10 to $30 million check size. I'd say that the in the market now it's sort of a tale of two stories. There's companies that are really hot, have a lot of momentum, can raise in 2 or 3 days. They sort of have a bunch of investors trying to preempt. They put together a small data room. The data room is out, for a day or two, and then offers start coming in, and then they pick their party. That's like the extreme, on one side. On the other side, you've seen companies, that take, 3, 4, 5, 6 months to raise, and it's a harder and longer process for them. I think, a few things to note. One is, all VCs talk. And so it's good to have, like think through your process ahead of time, figure out who you've built relationships with, keep it to, a certain group, try to sort of phase it. So have initial meetings, in the first week or two, sort of get some initial feedback, make sure there's interest before you start sending your data room, that stuff around, and just try to, keep funds moving along. I think, where it gets a little tougher is when investors start passing and then they tell other investors and then they start seeing, oh, I actually talked to this founder 3 months ago and then someone else sent it to me and they're still raising. And then it just seems like, a lot of investors have passed and then you start scratching your head on, all right, what have other people seen? What have been the reasons, et cetera? So it's really like a momentum game, and I think that drives a lot of it. In terms of dilution and valuations, I would say the range is sort of like 10% to 25% dilution is what we see a lot of times. 30% is like the highest end, and then, of the most dilution, and then some of these crazy rounds might be 5% dilution if it's a multi-hundred-million-dollar valuation for some hot AI Series A. But I would try to anchor to like that. If you think you could run a quick process, if you have a lot of external interest, maybe anchor to closer to 10 to 15. And if you think it's going to be a bit harder, or you're earlier in the metric side, or there's like less AI, or the growth rate is a little slower than some of the best in class companies, then maybe you're anchoring more towards 20 to 25% dilution. I think it's also when you go out in your fundraising deck, does it say you're trying to raise a $20 million Series A versus a $10 million Series A? Like the founder's confidence and the headline number impacts that a lot. And to the signaling piece, like if, I met a founder and they were trying to raise a $30 million Series A, and then 3 months later, someone else sends me the deck and the deck says only $10 million Series A, it's a clear signal that the founder had these big ambitions, wanted this huge splashy round, and the market, had different feedback. So I would just be really careful around signaling the materials you're sending out, knowing VCs, talk a lot.
Awesome. That's gonna be a helpful overview, and I'll also do some of the tips as well. So want to transition now that we have some overviews as far as like the current state of fundraising across various stages into a few different topics. And Neil, we'll start with you on this because I know you mentioned AI, right? And one of the things I wanted to spend some time discussing is the current trends in marketplaces, and of course we couldn't talk about that without AI. So could you maybe share a little bit more about the kind of trends that you're seeing with marketplaces right now?
Yeah, I think about it in a pretty simplistic structure, right? Like marketplaces are really tough businesses because there's a lot of things that marketplace founders have to do. Like operationally, you have the hardest amount of customer support, marketing, and those are all like high cost centers to some extent, like operationally too, logistics if you're working with real goods. All these things are really complicated problems. Now, what's really good at solving complicated problems is AI if you structure it correctly, and cheaper than all of your other potential applications to solve this. So I take like a few clear examples that we're seeing immediately right now. Customer service, all of the sort of agentic approaches to that with voice, with chat. I actually just saw one recently that is trying to structure voice support, web support, and chat support in one. So basically, like replace Zendesk completely with agents. And that's a fraction of the cost. I think they were saying the normal sort of marketplace would pay like $30 per hour for these sort of agents, and they're charging two with similar outcomes. And they're replacing like 90% of the cost structures there, right? So if you think about how much that's savings for you as an operator of a marketplace, that changes your profitability quotient completely, which means you can do one of two things. You can either charge less or have higher margins. So I think any founder that's running a marketplace, even if it's not an AI startup, I think all marketplaces right now are AI startups. That's what I like try to hammer home with the folks I'm talking to, because you can leverage all these AI tools to change the trajectory of your company. And why I was talking earlier about some of those like early stage investments being more important is that I think there are going to be marketplaces which traditionally have raised like D, E, and F rounds that maybe only raise a Series A round because they're able to basically bootstrap their cash flow and be very smart about how they're using cash to get to really high outcomes without having to raise future rounds. So I would think very, very critically about these tools that you're using for each part of your stack. It could be that you have. I led growth at Goldbelly. I had a really large team for 7 years. If I were to do it now, I could probably have like a team of three people running that if I had like built from the ground up. So I would think about it that way. How can you use very few people to leverage their talents and get 10x returns from that using these AI tools? And I could go on forever, but I want to let other people say it.
Yeah, no, that's great. Andrew, do you have anything you want to add or jump in here?
Yeah, no, completely. I agree 100%. I also there's a few observations on the AI stuff, especially from an investor perspective. I actually have this belief that marketplaces are the perfect sweet spot here because as for all those reasons that Neil mentioned, you can leverage AI to improve your business in so many um, really important ways. At the same time, if you're building just like an AI product or an AI tool, I'm very scared about investing in that stuff. And a lot of people are as well, because as you watch the space, tomorrow there's a better version of what you just built. And then the next day there's a better version of what that guy just built. And it's just a very hard space to invest in for that reason. It's really exciting and these products are amazing and they, 10x or 100x the existing solutions. But again, it's very, very hard to build defensibility. But what makes marketplaces so special, as all of you probably know, is the defensibility comes from the liquidity that you build up and comes from building the supply and the demand. And if you can get there faster through AI tools, that's fantastic. But the defensibility is actually coming from the players in the marketplace, not the actual software, if you will. So I feel like it's like the perfect sweet spot to invest because it's not crazy out of hand defensibility or valuations. It's also something that you can see, working over time. And the only thing I would add is, aside from like just all the things that you can do cheaper with AI than you could have done before that Neil mentioned, there's also stuff that you couldn't have done before at all that you can now do with AI. So One example, actually, maybe I shouldn't share the detail. I'll keep it anonymous, but we're working with one company that had a very complicated process involved in every transaction. It wasn't like a simple, go online, buy something, done. It was like a back and forth between the buyer and the seller. It would usually take, months to complete a transaction. There was um, all this, hand holding involved in it. In the case of AI, they're able to create a lot of those flows that they couldn't have created before in a seamless way. And then kind of most importantly, they're able to structure the data that they get from all of those flows to create these experiences, these marketplace experiences that couldn't have existed. So I feel like that's like one added thing to just the saving money part. And then the third thing I would say that we're seeing with AI is these kind of like AI with a human involved kind of marketplaces. So we've seen a few of these in kind of every category where it's like, oh, should I use like a marketing tool that can that replace my marketing manager, or should I like replace my recruiter with AI? There's a lot of these things where AI can help a tremendous amount, but most companies are going to then want someone, maybe not like the same size of team, but someone at the end of the day that they need to actually engage with to complete whatever job they're trying to complete. And that creates all these marketplace opportunities because if you can use that AI and then have the supply on the other end, um, again, you can build up liquidity that makes you very defensible. So super excited about AI for lots of different reasons.
Awesome. And then Matt, I believe you guys have also shared a few different kind of posts about it in the past as far as from headline on AI. So I thought it'd be helpful maybe if you can jump in here too and as well and share. And also too maybe I thought it'd be helpful to maybe speak to as far as like we've mentioned a few different times like how AI can change the trajectory at the earlier stages. So how is this I think like from the investor point of view maybe change those kind of benchmarks as well.
I think the biggest sort of criticism of marketplaces today is the why now piece, which investors are really hyper focused on. The best scenario for a marketplace is, big market where there's fragmented supply and demand, and you could use technology to, bring people together, accomplish a service, etc. It's not enough anymore just to have those dynamics. Like if it's, what we think about is, when we see a marketplace business, is this something that could have been done in the year 2000 with the internet, something like eBay or CarMax? Those had the good characteristics that was done 25 years ago. Or was it something that, was mobile enabled, like an Uber, like a DoorDash? Like that was sort of the technology shift that propelled those businesses. I think now, what we really think about is what's the why now? Like, is this a process? Is this some sort of service that literally, if you go back 5 years pre-AI, could not have been done? And those are the most compelling marketplace opportunities. Is there's a really strong why now due to like a cultural shift or this technological shift, which is AI, or a regulatory shift, which in government marketplaces and B2B marketplaces and fintech and healthcare, there's been regulation that have opened up these markets. So I think the why now is the most important piece that we look for in investing in a marketplace today. And then there's some characteristics and things that, as we think about the future, it's how we envision, marketplaces. So I think a few of the things there are, one is curation, marketplaces and personalization and understanding, what does a consumer want before they want it? It's not like Instacart or DoorDash where it's breadth of inventory and breadth of supply. You have all these options. Like it's a lot to think about. People just want to know, okay, you've ordered this before, or maybe this is what you want to buy before you even know that. And I think that curation and personalization, is going to be really, really important in making it, a no-brainer decision to make a purchase. I think on the back end, like what Andrew and Neel have mentioned, more there's efficiencies, in terms of supply, like can you use automations to allow supply to make more money, allow supply efficiency. It sort of changes the supply side economics of marketplaces. There could be agents, where in the past it was human labor, so sort of like new types of supply. And then I think the third thing that we've talked a lot about internally is trust and safety. Like how can you automate and use the latest technology to make the trust and safety piece, which historically has been really manual and human intensive. How do you sort of automate that, which is really important to trust in any marketplace?
That's gonna be super helpful. So cool. So we're gonna get into a group Q&A here in a little bit. But I thought it'd be fun to do a kind of almost like a quick fire tips. So yeah, maybe if we kind of go around and we'll start with you, Neil. Could you maybe share like 2 to 3 kind of tips that you have for earlier stage founders when it comes to fundraising?
Yeah, I would say the number one thing is try to find your like evangelists and angels, the people that believe in you, right? Because they will unlock a lot of doors down the line. Even if they're small checks, I don't think the money really matters for them. It's or for you. It's more having people that are connected in the community that can help you at later stages and just give you advice along the way. I've done that as a founder multiple times. I think it's helpful to have those people in your back pocket. Number two, again, not to uh, focus on this, but I do think like I got a lot out of my accelerator experience. I think if you're running into roadblocks on your own, I do think incubators and accelerators are very helpful. I know people talk about the expense, but I think you'll make up for it in sort of like the valuation multiples that you get and just the structure that it puts alongside you as a founder. I've found it really helpful. I think everyone that I've talked to that have gone through the programs, especially good programs, I think I wouldn't just do any accelerator, but good programs really do help. And then last tip I would say is, you know, it is a momentum game. It it does require running a good process, but I think you have multiple bites at the apple, and I think some folks just go, okay, if I start a fundraise, I gotta like continue on and just make it happen and spend 6 months doing it. I would say if you start getting feedback that this is not the right time, like just take a breath, like take a step back, maybe focus on fixing something in your business, focus on growth. Growth at the end of the day wins all things. So if you ever see like stagnated growth, that can ruin things. But on the flip side, when you get into growth mode or profitability, that actually changes the equation and can completely change the dynamics of a fundraise. So that would be my last tip is just because you start a fundraise doesn't mean you have to finish it.
And what about you, Andrew? I'm sure you have some tips.
My number one tip on fundraising, which sometimes isn't in my best interest as an investor, is that not everybody should be fundraising. And so this is kind of a silly thing. I say it a lot though, is like venture capital, like going down that route of raising venture capital is a very specific game, and it may not be right for all companies. So I would say like that's the number one thing is like figure out early on if you need the capital in order to achieve the massive outcome that you're aiming to achieve, or if you're raising money just because it's the thing that everybody does when they're starting a company. Like I would just think about that because it is a one-way street. I can tell you my own personal experience having been in a few different startups. The one where I didn't raise very much money, we bootstrapped along the way. We ended up raising a little bit to grow. Like that was a fantastic outcome for us, for me personally, for my colleagues, everyone else. The company where we did raise a lot of money early on and they kept on raising more and more and more to grow faster and faster, that ended up being a zero for everyone. So anyway, just very that's an N of two like anecdote, but just that's my number one thing I tell people early stage is to think about whether they need capital and whether venture is the right path. If you are going to go down the venture path, I think the number one thing is traction. And that sounds like, oh, that's so obvious and so trite, but it really is true. Like if you can show traction and focus on traction in the business, the fundraising process becomes really, really simple. If you don't have traction, the fundraising process is just an enormously difficult thing. And almost like you just focus on traction more than anything else, and the stuff does take care of itself to a certain extent. There are, you know, practical things that you need to do. You need to run a process. You need to have the right people you're talking to. You need to reach out through connections so you can get warm intros. But traction. That's what matters the most. I think persistence is helpful, but I think you have to have like the right kind of persistence. So in other words, if you're hearing no from an investor, you're never going to change their mind by essentially refuting the reasons that they say no. But if you are hearing no from an investor or from set of investors, and then you keep on updating people over time in terms of the traction that you're seeing in the business, investor updates are, a phenomenal way to stay in touch and to not potentially change minds or get someone over the line. And I say that specifically on the persistence front because a lot of people think about, you know, sales and grinding, and you just got to keep on asking and asking. That's not really true in fundraising. You've got to build those relationships, but then the persistence of updating on how things are going, I think is most important.
Hey, Matt, we'll get here's some tips from me if you don't mind before we get to the group Q&A.
Yeah, I think if you think about the investor mindset and sort of how it works on our end, a lot of investors make like one, two, three investments per year. And we're talking to 20, 30 companies a week. And we see so many companies that are growing really fast. I think with AI and this adoption, we're seeing a few companies a week growing from 0 to 1 million monthly active users or 0 to 5 million of revenue run rate, like very quickly. So we're seeing a lot of things with this really high growth bar. And so I would say that the other two, besides growth, and it used to be like growing 100% year over year was strong. Now the best companies we're seeing are growing from like 0 to 10, 0 to 20 million of revenue. It's really crazy how quickly companies are growing, and the top tier rounds, as I mentioned, the ones that take a few days to raise, have low dilution. These companies are growing, 5x, 10x year over year versus, 2x, which was good 5 years ago. So just the bar is high, and every VC gets to make only a couple bets every year. The other two things, given we're seeing so many opportunities, the why now, as I mentioned, is really, really important. We talk a lot about moats, about sustainable differentiation. Like, how does this company, build, true structural advantage? And then I would really also play to your strengths in terms of, what are your team advantages? What are your structural advantages, for maybe distribution or customer acquisition or these other things? Like, it's so hard, to make the right choice and to, have these, 1,000x venture returns that you want to, if you're in our shoes, you want to find companies that have some unfair advantage. So we spend a lot of time thinking about like, how is this a cheat code for dominating this market or that market? And the more true advantages you have, and highlighting those, the better.
There's a lot of companies growing. I think the place that I would focus on is retention, either customer retention or net revenue expansion if you're B2B, because that is the switching costs for a lot of companies are lower. So if you can improve growth and retention, that to me, like those are the companies that have been doing the best recently.
Chibi, do you want to come on and help kick off the group Q&A?
Thank you everyone for being here. I don't have a direct target for the question, but my question is though, I'm a college student starting a marketplace, and I really wanted to know what is the biggest mistake you see a lot of first-time founders make when it comes to marketplaces. It has its own unique issues. So I just wanted to know if there's a recurring issue that you see come up a lot.
I would say the number one thing I see is it's not a bad thing, but it's a mistake a lot of first-time founders do, which is being like overly ambitious in your initial vision. I like founders that have a really ambitious, like long-term vision or like concentric circles that they can build. But some folks, I think, try to take on too much. I did it myself. I like tried to do everything with my first company, and it took on way too much risk. There's a lot of problems with that, which maybe is self-explanatory. But I think a lot of people think that because marketplaces have to have big outcomes, you have to have this like grand vision. That's true maybe down the line, but focus on like an initial win, something that you can tackle, that you have a unique advantage at, that you can have accumulating advantage built up over time, and that has the ability to sort of like translate into other verticals, build concentric circles around it. That's much more of a winning recipe. There's very, very few companies that have started with like a compound app that you can build. Like Rippling is probably one of the unique exceptions to the rule, but Parker was also like already a builder in this space.
Awesome. That's gonna be helpful. Hey, I know I saw you raise your hand. You want to come on?
Thanks. So I think my question is for Neil and probably Matt as well. Do you have any tips for European-based founders on raising in the US pre-seed seed stage between 20 and 30K MRR?
Yeah, I can start off and then happy to pass off the mic. The so I think it's a lot easier for European founders that are selling in an American market to raise from American investors. I think it's very difficult, at least from what I've seen for European founders who are like selling to companies in Europe, to get American investors. Maybe exceptions, but at least from my point of view, that's the sort of way to go. I would say if you do have customers in the US, start by trying to get your customers to become investors, right? Like that to me is the biggest proof point. If they buy into your beliefs, or into your product and they become investors, that'll ripple effect into other angels, into other funds, because they'll get that proof point of, oh, they're a customer and an investor. They maybe actually really do need this product and maybe fills a void in the US.
Just to add, I mean, we have a separate European fund, so happy to put you in touch with those folks. And there's a lot of great early stage funds across Europe. So if the customer base, or if it's a sector like healthcare, or like insurance, which or fintech, which is drastically different in the US versus Europe. A lot of times it's easier to raise your first round from a European fund. I think, just to add, having a mostly US customer base, whether it's consumer or B2B, is helpful. And then I think, getting sort of people prepped and then spending time, like spend like 2 or 3 straight weeks in San Francisco. Ideally, once you've already had intro calls and sort of garnered initial interest, because it's really hard doing it over Zoom. Like, I think spending a few weeks here in person, making the rounds, trying to close your process is the best path.
Thank you.
Hey, Jeeth, you want to come on?
Yeah, my question was more about startups getting into this phase where they're raising smaller seeds and getting towards profitability. How do you look at that as an investor?
Well, forget about it as an investor, as an operator. I think it's phenomenal to be able to control your own destiny and to be in a position where you don't need capital. I mean, it's like anything else in life. When you don't need capital, it's easier to get capital. If you desperately need it, it's harder. And so, yeah, being able to get to a point where you control your own destiny is sort of the name of the game here. And then investors are never going to be like pushed, like never going to be like, turn away because, oh, this company's too profitable too early, it doesn't need my money. I think it just gives you more optionality.
I think to add, like, if you take on venture capital investors, you have to know that their goal is to build it into a billion, 5 billion, 10 billion, $50 billion company. Full stop. Like that's how the venture model works. And so, there's a ton of companies that are amazing lifestyle businesses that you could, be profitable, make $1 million in EBITDA, pay yourself really well and grow 10%, 20%, et cetera. Like that doesn't work for the venture model. And so just knowing if you're, going the venture route, you're going to be pushed to not grow at all costs, like grow, there's a balance of growth, profitability. A lot of it comes down to, what's the size of the market? What's the momentum? Can you raise the next round, or should you cut burn and focus on getting more profitable just to give yourself optionality to try X product, Y product, more things that could get that venture scale outcome. But typically like you hear like rule of 40, which is, growth and EBITDA and sort of orienting towards, a certain combination, but that's more of like a private equity type way of thinking versus venture, which is, built on these $1 billion plus outcomes.
Hey, Danny, do you want to come on?
You talked about Europe, but you haven't talked about Canada, which is in the middle of that Trump tariffs war. Do you guys invest in Canada right now, in companies that intend to scale in the US? Another thing is it's really hard to reach. I'm in the middle of a seed round, so you reach so many potential VC funds that don't reply to you. So how do we reach you? Because that's one of the problems, is just to get an answer. And what's your turnaround in a deal once you have interest, enter due deal? What kind of is it these days for you?
I think it really depends. But if you're selling in the Canadian market, and like that's the idea, that Canada's obviously a very, very small market compared to Europe, or even compared to the US or even Europe. So Canada as a market, or where the product is just aimed at the Canadian market, it's going to be tough to get US investors interested. But there's a lot of founders, like tons and tons of founders from Canada, that build what I would consider even US based or North America based startups that are selling into the US market, that have no issue raising money. Um, so it's not like, oh, it doesn't create any sort of red flags or any sort of barriers, at least as far as I've seen. I don't know if Ajit, you've seen something differently, but I would also say that it does help to come to San Francisco. There's so much critical mass here, and that's not just true for founders in Canada. It's true for founders all over the US and smaller markets. It's just harder to get on people's radar if you're not here, and there's so much happening in the ecosystem that helps make connections and will help lead to um, that investor. So I'm a very big bull on being in San Francisco, or in a hub if you can.
Hey, Matt, do you have anything you wanted to jump in and share on that?
Yeah, I mean, I think it's a great market. There's a bunch of awesome seed investors. So I would tap into the local Canadian seed investors, and we get a lot of deal flow from them. And so I think they do a good job of connecting, Canadian founders to the bigger US funds. There's great talent in Canada. There's, Toronto, Vancouver, a lot of good founders, and founder density in those cities, Waterloo, et cetera. So, if you're raising like a pre-seed or seed, I try to get some of the blue chip Canadian funds interested, because they do a great job bridging and introing their founders to the top US based funds.
We'll try to get in two more questions, so I know we only have a few more minutes. But Sanjay, do you want to come on?
Yeah, thanks. So my question for marketplace investors, to the extent that you guys invest in marketplace startups, so you have your normal rubric of things you look for, the classic, GMV, take rate, churn, ARR, TAM, all of that. But to what extent do you guys think about how long the company has been in operation? And what I'm getting at is that building network effects in a marketplace sometimes can take a while, until the point you hit a point of inflection, and then it takes off because now you have both sides, and buyers bring sellers, sellers bring buyers. So how much weight do you put on how long the company has been around?
Yeah, I could take this one. I think like when we're sourcing from the outside in, it's definitely a factor we look at. Like we'll look at, if we're looking at a list of 100 companies, and we'll look at like how many employees does the company have, and how fast is the employee growing. Are there certain signs of momentum? When a company's been around 10 years and they have 5 employees or 3 employees, it's like, well, it doesn't seem like it's sort of gotten to hyperscale yet. That's from the outside in. I think once you're actually engaging with the VC fund, it's all about momentum and storytelling and the narrative. So, some companies have been around, they tried X, Y, and Z, pivoted, and that's fine. If now you have a story of like, hey, in the last year we found this product market fit, and the numbers are all up and to the right. So I think really once you get in the door and you're talking to a venture fund, it's all about the narrative, what you learned, and why there's momentum like at this very moment.
Just to follow on to that a little bit, because I think specifically there's a marketplace element to this as well, which you're right, Sanjay. A lot of marketplaces take a very long time until they look like phenomenal businesses. I mean, there are exceptions to that are growing, extremely rapidly at the beginning, but that's not always the case. And just to use some examples, we obviously talked a little bit about YC, but some of the marketplaces that have come out of YC that have gone on to really big success were like the least popular deals at demo day. And I don't think that's a coincidence. I think it's because it's harder to show that spark early on, and sometimes it takes a long time to see the momentum there. So just an observation more than advice or anything like that. I think that in marketplaces, it is a little bit of a trait that you will see more commonly. So using it to your advantage, if that's if that's the marketplace you're building and it's taking you longer, but you're seeing these signals that you're about to hit that inflection point, I think that story holds a lot of water. And, I remember, well, not remember personally, but I know like Vetco, a company coming out of YC, was like one of the, nobody wanted to do that deal. That's now a multi-billion dollar company. Chef, I remember coming out of YC, so I just would be familiar with this. It was like one of the least popular deals, and I really love that business as well. So it's these marketplace deals take longer to marinate. So I agree with you on that front.
Awesome. We'll try to get in one last question if we can. Hey, Jacqueline, do you want to come on? Saw you raise your hand.
Yeah, so I just had it's more about, do you guys have any advice for founders that are entirely consumer marketplace focused right now? Because I have seen a shift in the last 2 weeks of raising, even with investor sentiment and almost being a little bit afraid of their shadow with consumer companies. And then also they're getting a lot of strain from portfolio companies as well. So yeah, just any advice there.
Hey, Matt, I think this might be a good one for you to jump in on.
Yeah, no, I love consumer and feel like consumer investors are a rare breed these days. I think it's a couple things, especially for marketplace businesses. The biggest challenge in the last, well, I'll say two things. From a macro perspective, if you rewind 15 years for consumer, there's like two variables for consumer. There's spend and there's attention. And that box has sort of, since, people have mobile and Wi-Fi and can get the internet every second, those boxes have not grown in 15 years. So if you're trying to get consumer spend, you're taking a share from Amazon and all these, Walmart, all these large e-commerce companies. And if you want attention, you're taking share from Facebook, WhatsApp, Instagram, TikTok, etc. That's really hard. And it's why a lot of VCs like B2B, it's just easier, more money, etc. So I think for marketplaces, the big things we look for are, one, is there like a hero KPI? Like, is it like time in the app or time on the site? Is it like the amount of spend consumers are spending per year? It has to be like some crazy number that's off the charts. Like you need some kind of one hero metric that's, best in class and like eye popping to really get investors' attention. And then the other thing is given consumer has lower retention generally than B2B and enterprise companies, one thing we look for is supply driven demand because you're not, so if like Cameo or these other companies where your supply is actively doing customer acquisition, trying to bring in customers for you. So you're not spending, marketing dollars on Meta and Google and all these things trying to find your next customer. Those loops are really, really impactful in marketplace businesses. So I would focus on those elements.
Awesome. That was a great last question to wrap things up for all the consumer founders in the community. So, all right, I know we're out of time here, but I appreciate you all taking the time to join us here today. And we tried to kind of pack it in with the intros and kind of overviews of the current states and some of these topics and group Q&A as well. So, I'll also too I'll include links for everyone. That way they can kind of reach out to you, whether it be in the community or directly in the recording for this. But yeah, thanks again for joining us here, Neel. Thanks Andrew, and thanks Matt for joining us, and then everyone for the great questions today.